Alex and Jordan both earn $72,000 a year. Same city, same job title, same paycheck hitting their account on the 15th of every month. At the end of the year, Alex writes a check to the IRS for $11,200. Jordan pays $1,900. Same income, completely legal, the same federal tax code. And here's the part that should make you put your phone down and pay attention. Jordan didn't hire a fancy CPA, didn't have a trust fund, a loophole, or an accountant who plays golf with a senator. Jordan just understood 6 things about the U.S. tax code that most people earning $70,000 a year have never been taught. And once you see what those 6 things are and run the actual math, you're going to realize that the IRS isn't stealing from you. The school system just never taught you how to read the bill. Here is the single most important thing I want you to understand about taxes before we go any further. Most Americans in the middle income range, people earning anywhere from $45,000 to $130,000 a year, are dramatically overpaying on their taxes. Not because they're cheating, not because they're being reckless, but because they're using almost none of the legal tools the IRS has built into the tax code specifically for them. The wealthy use these tools constantly. Their accountants know them by heart, and the strategies, every single one of them, are completely available to someone earning $60,000, $80,000, or $100,000 a year. Today, we're going to go through all of them. If you're new here, welcome. This channel is about building real financial understanding, not just tips and tricks. Hit subscribe if that sounds like something you want more of. I post every week. And before we get into this, quick question. When someone tells you they're in the 22% tax bracket, how much do you think they actually pay in taxes? Most people get this wrong, badly wrong. And that's exactly where we're starting. Here's the misconception that costs middle-income Americans billions of dollars in unnecessary stress and sometimes unnecessary payments. Say you earn $75,000 a year and you're a single filer. Someone tells you you're in the 22% tax bracket. Most people hear that and think, I pay 22% of everything I earn. That's $16,500 in taxes, right? Wrong. The United States uses a progressive tax system. Source, IRS Brackets 2025. You don't pay your bracket rate on all your income. You pay each rate only on the dollars that fall within that bracket. Here's how it actually breaks down for 2025. OST, 2025 standard deduction, $15,750 single. First, you subtract the standard deduction, which in 2025 is $15,750 for a single filer. That brings your $75,000 down to $59,250 in taxable income. OST, taxable income, $59,250. Then the tax brackets kick in, and this is where it gets interesting. The first $11,925 of that taxed at 10%. That's $1,192. The next $36,550 taxed at 12%. That's $4,386. The last $10,775 in the 22% range taxed at 22%. That's $2,370. Your actual tax bill at $75,000? About $7,949. An effective federal rate of roughly 10.6%. Not 22%. 10.6%. Here's why this matters so much. When people believe they pay 22 cents on every dollar they earn, they start making decisions based on that fear. They avoid raises because I'll just lose it to taxes. They avoid selling investments because I'll get hammered. They miss opportunities because they've built a story about taxes that isn't true. Now, here's where it gets interesting. Because 10.6% is what you pay if you do nothing. If you use even one of the strategies we're about to go through, that number drops significantly. Use all 6, you could be looking at an effective rate closer to what Jordan had at the beginning of this video. Let's go through them. Strategy 1 is the foundation of everything else. And most people are only using half of it, the 401k. In 2025, you can contribute up to $23,500 to your employer's 401k plan. If you're 50 or older, that limit goes to $31,000. If you're between 60 and 63, it goes up to $34,750. That's a new rule from Secure Act 2.0. Now here's the part most people don't fully appreciate. Your 401k contribution comes out of your paycheck before taxes. That means it reduces your taxable income dollar for dollar. Let's go back to our $75,000 earner. If they contribute the maximum $23,500 to their 401k, their taxable income before the standard deduction drops to $51,500. After the standard deduction of $15,750, $35,750 in taxable income. Their new tax bill? About $4,052. That's a tax savings of nearly $3,900 every year. Not in some offshore account, not through any complicated structure, just by using the account their employer probably already offers them. Now, I know what you're thinking. I can't afford to put $23,500 a year into retirement. I have bills. Here's the thing. You can't afford not to. Because that $3,897 in annual tax savings is money that would have gone to the IRS, and it's now sitting in your retirement account, compounding. Over 30 years had an 8% return. That $3,897 in annual tax savings alone, if invested, grows to over $480,000. But that's just strategy one. There's more. Because the 401k is just the beginning of the stack. And when you layer these strategies on top of each other, the math becomes almost absurd in your favor. The Health Savings Account, the HSA, is the single most powerful tax-advantaged account available to the average American, and almost nobody uses it correctly. In 2025, if you're enrolled in a high-deductible health plan, which millions of employer plans qualify for, you can contribute $4,300 if you're covering just yourself, $8,550 if you have a family plan. Now here's what makes the HSA genuinely unique in the entire US tax code. Every other account gives you one tax advantage. A 401k, pre-tax now, taxed on withdrawal. A Roth IRA, taxed now, tax-free later. The HSA gives you three. Contributions reduce your taxable income now, like a 401k. Growth inside the account is tax-free, like a Roth. Withdrawals from medical expenses are completely tax-free, unlike anything else. And here's the part nobody talks about. After age 65, you can withdraw HSA money for any reason, just like a 401k. You pay ordinary income tax, but no penalty. It essentially becomes a second retirement account. Which means if you invest your HSA funds, not just let them sit in cash, this account can function as a powerful, completely tax-sheltered investment vehicle. The HSA is not a use-it-or-lose-it account. The money rolls over every year, forever. If you started maxing a family HSA at 35 and let it compound at an 8% return until 65, you'd be sitting on over $1 million in that account, tax-free for medical expenses, which by then will probably be significant. So far, we've covered two strategies, the 401k stack and the HSA. For our $75,000 single filer, using both would bring their taxable income down to roughly $27,450. That's almost $48,000 below their gross income. And we haven't even talked about the most unexpected strategy yet. The one that lets some middle-income earners pay literally zero in federal capital gains tax. Most people assume that if your investments go up in value, you'll eventually pay capital gains tax when you sell them. That assumption is often wrong. The United States has a long-term capital gains tax rate of 0% for people whose taxable income falls below certain thresholds. In 2025, that threshold is $48,850 for single filers, $96,700 for married couples filing jointly. Remember our $75,000 earner who maxed their 401k? After that, their taxable income was $35,750. $35,750 is well below $48,350. This means they can sell investments that have appreciated in their taxable brokerage account, stock funds, ETFs, whatever, and pay zero federal capital gains tax on those profits. This strategy is called tax gain harvesting, and it's the opposite of what most people do when they think about taxes and investments. Here's how to use it. At the end of each year, look at your taxable brokerage account. If your income is low enough to fall in the 0% zone, consider selling appreciated positions, locking in the gains tax-free, and immediately buying them back. You just reset your cost basis higher, meaning less capital gains tax later in life when your income might be higher. This is completely legal. The wash sale rule, the rule that limits selling for losses, does not apply here because you're selling at a gain, not a loss. Think about what this means. Two people, same income, same investments.
One lets their gains accumulate until they're $65,000 in gains, pays 15% on hundreds of thousands in gains. The other harvests gains every year they're in the 0% zone, pays nothing. Same stock market, very different tax bills. In 2025, you can contribute $7,000 per year to an IRA, either traditional or Roth. $8,000 if you're 50 or older. The Roth IRA contributes after-tax money. You get no deduction today. But every single dollar inside that Roth, contributions and all the growth, comes out completely tax-free in retirement. If you contribute $7,000 a year starting at 30 and earn 8% returns, by 65, you've contributed $245,000. But the account could be worth over $1.2 million. All of it completely tax-free when you withdraw it.
There is an income limit for direct Roth contributions. In 2025, you can contribute the full amount up to $150,000 in modified adjusted gross income as a single filer. If your income is below that, which it is if you've been stacking the 401k and HSA, you qualify. Now, there's a second move here for people who earn above the limit, the backdoor Roth. You contribute to a non-deductible traditional IRA, no income limit on that, and then immediately convert it to a Roth. The IRS has known about this strategy since Roth IRAs existed. As of 2025, it remains fully legal. I want to be clear. This isn't a gray area or an aggressive tax position. It's a straightforward use of two provisions in the code that work together.
This next strategy sounds complex, but the core idea is simple. If any of your investments go down in value, you can sell them at a loss. That loss can offset capital gains you have elsewhere. And if losses exceed gains, you can use up to $3,000 of those losses to reduce your ordinary income, your salary income, per year. Excess losses carry forward indefinitely to future years. Now, there's one critical rule you must follow, the wash sale rule. If you sell an investment at a loss, you cannot buy back the same or substantially identical security within 30 days before or after the sale. The solution is simple. Sell one ETF and immediately buy a similar but not identical one. For example, sell a total US stock market fund. Buy an S&P 500 fund. You stay invested, you capture the loss, you don't violate the rule. This strategy becomes especially powerful in volatile years. Market dips that feel terrible are actually opportunities to lock in tax benefits while staying fully invested for the recovery.
These deductions don't require complex tax planning. They just require knowing they exist.
Here's something most people don't realize about the tax code. There are two types of deductions. Those that go below the line, meaning you can only use them if you itemize instead of taking the standard deduction. And those that go above the line, meaning you get them even if you take the standard deduction. For most middle income earners, the standard deduction is worth more than itemizing. But here's what many of them miss. You can still stack above the line deductions on top of the standard deduction. The most impactful ones you may qualify for: student loan interest, up to $2,500 per year if your income is below $80,000 single. Source IRS Pub 17. Self-employed? You can deduct 100% of your health insurance premiums directly from your AGI and 50% of your self-employment tax. HSA contributions, as we covered, fully above the line. Traditional IRA contributions, deductible from AGI if your income falls within the limits. These deductions don't require complex tax planning. They just require knowing they exist. Here's something most people don't realize about the tax code. There are two types of deductions. Those that go below the line, meaning you can only use them if you itemize instead of taking the standard deduction, and those that go above the line, meaning you get them even if you take the standard deduction. For most middle-income earners, the standard deduction is worth more than itemizing. But here's what many of them miss. You can still stack above-the-line deductions on top of the standard deduction. The most impactful ones you may qualify for: student loan interest, up to $2,500 per year if your income is below $80,000 single. Source IRS Pub 17. Self-employed? You can deduct 100% of your health insurance premiums directly from your AGI and 50% of your self-employment tax. HSA contributions, as we covered, fully above the line. Traditional IRA contributions, deductible from AGI if your income falls within the limits. These deductions don't require complex tax planning. They just require knowing they exist.
Here is exactly what to do. This week, pull up your HR portal and check your 401k contribution rate. If it's below the 2025 maximum of $23,500, increase it, even by 1 or 2%. Every dollar you shift pre-tax saves you real money now. This month, find out if your health plan qualifies as a high-deductible health plan. If it does, open an HSA at a provider like Fidelity or Lively. Start investing those HSA funds. Don't leave them sitting in cash. This year, open a Roth IRA if you don't have one. At your current tax rate, Roth is almost certainly the better long-term choice. Contribute the maximum $7,000 before the April 2026 tax deadline. Then, in December, look at your taxable brokerage account. If your income has been reduced enough through these strategies, consider harvesting gains at the 0% rate.
Remember Alex and Jordan from the beginning of this video? Both earning $72,000. Alex paid $11,200 in taxes. Jordan paid $1,900. Jordan maxed a 401k, contributed to an HSA, had a Roth IRA, harvested some gains in the 0% zone, deducted student loan interest above the line. None of it was illegal. None of it required a CPA, a tax attorney, or a minimum net worth. It just required knowing the rules of the game well enough to play it. The IRS code was written with these provisions on purpose. The government wants you to save for retirement, wants you to have health coverage, wants you to invest for the long term. So they made doing all of those things tax advantaged. The question isn't whether these strategies work. The question is whether you're going to use them. If this opened your eyes to how the tax code actually works, subscribe. We go this deep on every financial topic we cover. And if you want to go further on building tax-free wealth, I made a video specifically about Roth conversions and exactly when to use a traditional versus Roth IRA. The link is right here. Your future self is going to file their taxes and either feel like Alex, writing a check they didn't have to write, or like Jordan. That decision starts today. If this opened your eyes to how the tax code actually works, subscribe. We go this deep on every financial topic we cover. And if you want to go further on building tax-free wealth, I made a video specifically about Roth conversions and exactly when to use a traditional versus Roth IRA. The link is right here. Your future self is going to file their taxes and either feel like Alex, writing a check they didn't have to write, or like Jordan. That decision starts today.